We are very positive on the U.S. economy continuing to grow in 2025. There are a lot of potential pro-growth policies that have yet to make it from the campaign trail to being signed into law on Washington, D.C., and investors are going to have to wait a little while longer to get further clarity on those. Pro-growth policies, such as lower tax rates and increased U.S. energy production, should keep the U.S. corporate default rate low and allow investors to collect a high coupon for their U.S. short-duration bond investment. One shift in policy that the market is already fairly confident about has been the incoming administration's looser stance on M&A and deregulation when compared to the previous administration. Post the decisive outcome of the U.S. election in November, investors are already taking note of a pickup in announced transactions. Allowing more U.S. M&A to be successfully completed is particularly helpful to more leveraged U.S. corporate debt issuers if they are able to successfully monetize a business unit to reduce leverage or are ultimately acquired by a better capitalized company and are able to increase their overall credit profile. This economic backdrop is very favorable for U.S. credit, especially U.S. high yields. Many U.S. short-duration bonds that have been recently issued will continue to benefit from a coupon advantage in 2025 when compared to older vintage, longer duration, lower coupons of similar credit quality. This dynamic was beneficial to performance in 2024. Should risk-free rates continue to be viewed as high or restricted by U.S. corporate finance departments, then we believe their continued preference will be to issue shorter duration, higher coupon debt obligations. Bonds are often seen as a more stable, less volatile, income-producing investment option for investors. To optimally achieve this outcome, we think a good bond solution should be mindful of three risks: interest rate risk, credit risk, and liquidity risk. Of these three risks, investors have tended to be most confident about the credit risk and liquidity risk of investing in the large U.S. corporate debt asset class, while U.S. economy continues to expand at a pace that often exceeds many other large developed markets. By contrast, interest rate risk has and continues to be highly variable. Investors value that compared to the rest of their investment portfolio, U.S. short duration has shown to be able to provide this low volatility, income-producing investment in the face of uncertain interest rates. We believe a reallocation of some of core bond holdings with U.S. short duration high yield bonds could enhance outcome payout at the same time reducing interest rate risk exposure. Under the backdrop of continually expanding U.S. economy, U.S. short duration bonds, particularly U.S. short duration high yields, stand out as a solution offering a higher coupon and less interest rate risk than many traditional liquid fixed income alternatives, should interest rates pause or even rise from here. Conversely, should interest rates fall from here, U.S. short duration bonds with fixed coupons stand to produce a potential capital gain relative to many other low or no duration alternatives such as money market funds or floating rate debt. As we observe the U.S. high yield market over time, there is a noticeable trend of declining volatility as a bond gets closer to maturity. What many investors don't realize is that the return does not decline in a linear fashion. Because of this large cone of volatility, but ultimately getting similar returns, active management and differentiated credit analysis seeking to maximize each unit of risk per unit of return can produce a very useful approach to this short duration, high yield asset class.